Guys, the Dow was down about 700 points today based on the news about Credit Suisse Bank in Switzerland. Just when we thought our only problems were because of US banks, now we have to worry about European banks as well. So let's take a look at what the news is, why the market fell, and why it kind of bounced up a little bit at the end of the day. So this article in the Wall Street Journal says that the Credit Suisse stock decline tests the strength of European banks, and investors fear over contagion drive market rout after Swiss lenders drop. So Credit Suisse fell about 31% today, and those fears of contagion drove a market rout that wiped out about $75 billion of the value of European bank stocks. Now, the regulators claim that the policies they put in after the 2008 financial crisis puts the EU banks in actually a better position than the US banks. Until Wednesday, European banking stocks fared better than their US peers after last week's collapse of Silicon Valley Bank. But the drop in Credit Suisse shares on Wednesday marked the stock's largest one-day fall on record, and the stock closed down 24% on the day. And comparing the EU bank index compared to the US bank index, they were doing a lot better until today. Although the US bank index is still down something like 30% or so. Now, they're saying that the banks are mandated to have enough liquid assets to cover 100% of estimated cash needs for a month during a crisis, and that the EU banks' liquidity coverage ratios are also far higher in Europe than in the US. And so they say EU banks have an average ratio of 165%, while the US group had an average ratio of 118%. All that doesn't matter much when Credit Suisse stock is dropping 30% or so. And they say government and agency securities make up 40% of bank holdings in the Euro area, but 80% of bank holdings in the US, according to Moody's. All those facts don't really matter when everybody's panicking, and the fact that Credit Suisse is a too big to fail bank. And that's not just an opinion, they are considered SIFI, meaning systemically important financial institution. So unlike Silicon Valley Bank, Credit Suisse is classified as systemically important by the US Financial Stability Board, meaning it's too big to fail, as a collapse has the potential to trigger a financial crisis. And why is that? Because their assets under management were about 1.3 trillion Swiss francs, or about $1.4 trillion as recently as last month. And that's about 10% of the 14.5 trillion euro area economy. And if you want to see what's going on with Credit Suisse in one easy picture, just look at a picture of their credit default swaps. This is basically insurance on their bonds defaulting. And so during the Lehman Brothers crisis back around 2009, 2010, their credit default swaps only cost about maybe 3%. As of recently, they were hovering around 5%. Now they skyrocketed to 27% you have to pay per year if you want to buy insurance on your Credit Suisse bonds. And these sound like famous last words. Credit Suisse chairman Axel Lehmann stated the bank isn't considering government aid and that it would be inaccurate to draw parallels between its current difficulties and the collapse of SVB. We have strong capital ratios, a strong balance sheet. We already took the medicine, he said, referring to the restructuring program announced in late 2022. So Credit Suisse keeps racking up losses, has problems with their restructuring issues, and has delays in submitting its annual report due to material weakness flagged by the SEC last week. And on top of that, their biggest investor, the Saudi National Bank, was asked to put up more money in Credit Suisse, and they said the answer is absolutely not, for many reasons outside the simplest reason, which is regulatory and statutory. So the Saudi National Bank is 37% owned by the kingdom's sovereign wealth fund, and it is Credit Suisse's largest shareholder as of late 2022 with a 9.9% stake. So they don't want to go over the 10% threshold because of regulatory hurdles, and probably also because they've already lost about 500 million francs on their position. And the Wall Street Journal cites unidentified people familiar with the matter, saying ECB officials contacted lenders it supervises Wednesday to ask about financial exposures to Credit Suisse. If regulators do not handle the Credit Suisse situation well, this will send shockwaves through the whole sector. Head of bank research at ABN AMRO. So to make matters worse, both sides of the Atlantic have banking issues. And so after the European markets close, Reuters reported that according to another source familiar, Switzerland is facing pressure from at least one major government to intervene on Credit Suisse in the coming hours, given the systemic nature of the bank. So it doesn't take too much imagination to see Macron screaming down the phone as the biggest French banks crashed the most today. And additionally, the Fed is reportedly working with the U.S. Treasury to review Credit Suisse exposures. And just like the CEO of SVB Bank saying everything was great right before they collapsed, well, in this conference in Saudi Arabia, where the Credit Suisse chairman is right now, he said government assistance isn't a topic for the lender, as the Swiss bank sought to shore up confidence among shareholders and clients. But others are saying that's not exactly the truth, because now the Financial Times, according to more people with knowledge of the talks, says that Credit Suisse has appealed to the Swiss National Bank for a public show of support. It's looking inevitable that the Swiss National Bank will have to intervene and provide a lifeline. And of course, Bloomberg reports U.S. Treasury is
that I'm monitoring very carefully
the Credit Suisse situation and is in touch with global counterparts. And so just a little while later, Bloomberg reports that according to more people familiar with the matter, Swiss authorities and Credit Suisse are discussing ways to stabilize the bank. And so this is what led to the bounce in the afternoon in the U.S. stock market. So the firm's leaders and government officials have reportedly talked about options that range from a public statement of support to a potential liquidity backstop. Among the ideas floated include a separation of the bank's Swiss unit and a long-shot orchestrated tie-up with larger Swiss rival UBS. A statement from FINMA or the Swiss Central Bank would be coming soon. So here's a look at Credit Suisse. It dropped from about 250 to about 170 or so and closed out around $2 after these rumors of some kind of intervention. But that doesn't really help shareholders who are down about 98% since the highs around 2009. So down to like $1.70, $2. So not only is the credit risk for Credit Suisse rising, but the whole EU banking center credit risk has now jumped from the low 80s to above 122. And the ECB December 2023 rate change expectations are now down to only 3/4 of a point instead of being at about 1.6 percentage points. And the European Central Bank rate hike expectations for March, which happens tomorrow, went from being almost half a percentage point to now being just barely a quarter of a percentage point. And who knows, a lot can change from now until tomorrow. So guys, it looks like things are moving really quickly, and it looks like the dam is breaking in many places. So we have the dam break in regional banks in the US. They plugged that leak temporarily, and now you got Credit Suisse starting to leak as well. Let's see what they're going to do with that. Don't panic, but be reasonably prepared. So if you have all your money in just one bank or one brokerage account, you should definitely consider opening a few other accounts. And if you want a good idea of who owns the deposits that you put into a bank or a brokerage, and what are the insurance limits and SIPC limits for a brokerage account, check out this video over here. Thanks for watching, guys.
you.